So welcome to Personal Finance course lesson 3. This hopefully will be a shorter one, but I'm not sure which rat holes I might go down when I'm talking about some of this stuff. Subject of this lesson is risk. What is it? What does it mean? How does an investor respond? What classes of risk exist? And I've listed some of them there on the front of this slide by way of an agenda for this session. Of the knowledge component of this, I talked earlier about personal finance is 80% behavior, 20% knowledge. This is a very important component of the 20% knowledge part of it. I think if you understand this, then you can make better quality decisions that will avoid the pitfalls, avoid getting wiped out by making bad decisions. I'll give you an example of a bad decision I made years ago before I knew anything about any of this stuff. Back when I left GD to go and work at Alcatel back in whenever that was, 2000 or thereabouts, I had no clue about any of this stuff, and I had a little locked-in pension that had accumulated during the 4 years I'd been at GD, and I couldn't take it with me per se. It had to get put into what's called a locked-in retirement account, and I thought I was kind of smart, so I jumped on the stock trading bandwagon. I'd never been involved in any of that before. I didn't know anything about it, and I kind of read some of the stuff on the web in the time about certain Canadian companies that would perform really well, one of which was Nortel. And there's a spectacular video about Nortel in 2 parts on YouTube, which I will dig out and I'll find it for you and send it to you at some point. It's really worth watching. Nortel was of course a darling of the Canadian Stock Exchange. And I'm not getting into details because the whole video explains beautifully what happened there. But essentially, Nortel wiped out a lot of Canadian pension funds and cost a lot of people money. They cost me money as well. And there was another company that I'd found called Pivotal, was at the time flashed on the press as, a darling of the Canadian startup regime, where it was outperforming just about every market index. It was one of the fastest growing companies in Canada from a stock price perspective, and I put all my money in Nortel and Pivotal, and they both obliterated 4 years worth of savings in about 6 months, or maybe less even. So this little pension fund I had was worth at the time like $20,000 or something, and I put $20,000 in Nortel and Pivotal, and a few months later I had like $3,500 left. That same little locked-in retirement account now, 22 years later, is back to being worth about $22,000. So I've gained $19,000 worth of value back over about a 22 or 23 year period, which from $3,000 residual to get back to 22 over that length of time, pretty good in return. But what was sad, if I hadn't messed that up and I'd not lost the 80% of the value, that same $20,000 that I've got sitting in that locked-in retirement account now would be worth probably $100,000 or more if I'd not made a huge mistake by not understanding the mechanics of the markets and how to value a company and how to decide what a good stock and a bad stock. I could have had, I basically blew close to $100,000 by a couple of stupid decisions that I made back in 2000. Anyway, that's why this matters. It's crucially important. It is probably the most important aspect of knowledge with respect to this whole business. So off we go. Essentially, risk is about uncertainty. It's about not just an investor's inability to predict the future, but essentially anybody's inability to predict the future. It sounds simple, but it's not. It's very complicated. Basically, if you're a skillful financial analyst, you can look around the world and you can make predictions about what might happen. Very few people can say what will happen, because that would require just such a vast amount of knowledge to be assembled in one place and analyzed and understood. And by the time you've done the analysis, things would have changed. So generally speaking, what it means is you can't predict the future without some cone of uncertainty. As you further you look out in the future, the broader the cone of uncertainty becomes, and therefore the lower your ability to predict what's going to happen. Where does risk come from? It's the aggregate effect of real life on the plans of an enterprise, and therefore on the behavior of a market that is comprised of many enterprises. It's a combination of randomness, stuff that just happens, and what I've called here somewhat predictable environmental factors. So what does that mean? I mean, somewhat predictable means you could, for example, if we're in an area of like we are at the minute in Canada, where we've got very high interest rates, we've got high asset prices, you kind of could predict that we might end up in a recession. And there are some indications of that are out there. You don't know for sure, because you don't know exactly what everybody in the market's going to do, but you could kind of predict we were in a recession. You could have predicted, and I kind of did predict a couple of years ago, during COVID, when real estate was going through the roof, that there was going to be a real estate correction of some sort. Some house prices were unsustainable. The growth in house prices relative to real earnings was unsustainable. I even predicted that there's going to be something happen. Some change is going to happen. Well, guess what happened? Interest rates went up, made mortgages unaffordable for people, puts pressure on house prices. The market hasn't collapsed yet, and there's a whole different thesis on why that hasn't happened, but there has been a pretty significant correction, particularly in Toronto and Vancouver, but there are also other corrections in other parts of the country. The real estate market tends to respond slower than the stock market, things like that, but as occurred in the US in 2008, if it has collateral effects on the financial markets, it can be catastrophic. So you can kind of predict these things, but not with any certainty. Essentially, that means you can't know what happens. You can only approximate what might happen, and you can take steps through your investment behavior to get the benefits of investment while at the same time protecting against the worst case outcomes that might happen. All probabilistic language, nothing certain. One consequence of risk is what is called volatility. That is the propensity for an asset price to vary up and down in time. Different assets and different asset classes exhibit different volatility. We'll talk about that a bit more in the next sort of few slides of discussion here. And usually, but not always, higher risk means higher probability of long-term returns. So, and that's when measured at an aggregate level. I don't think you could say that about one particular company. You couldn't, for example, say, well, that company's higher risk and higher volatility, therefore it will produce a better return. What you can say is owning a portfolio that contains some higher risk assets that exhibit more volatility may produce a higher return in the long run, not tomorrow or the next month, but in the long run. I mean, this whole notion of the relationship between risk and return will keep bouncing around that. It's well studied throughout the financial industry, but again, it's about probability, not certainty. So what types of risk exist? We're going to talk about a few. The first one is market risk. That is what is also known as systematic or systemic risk. It's risk which applies to all players in a market. It's driven by macroeconomic factors, environmental factors, so things like wars, recessions, exchange rates, political, governments that get elected in that have a different propensity for promoting economic growth, natural disasters, hurricanes, earthquakes, technological breakthroughs. So for example, if a certain technology emerges that fundamentally changes the nature of a market, that will have a consequential effect on the players in the market. Within a broader market, different market segments carry their own version of segment risk, market risk at a segment level. For example, aerospace would carry a certain risk, and we've got some examples of that we'll come on to fairly shortly. Market risk can be global or localized. If you happen to be in Israel on the 7th of October, you would have probably seen some, and I don't know if this is true or not, by the way, but I'm supposing that there would be some impact on, Israeli companies as a consequence of Hamas storming into Israel on October 7th. When if there's an earthquake in a certain part of the world that damages an economy, that would be geographically affected, whereas other areas might not be geographically affected. So there's that aspect of market risk. And because in some ways it is this systemic risk, it kind of is what it is, and therefore represents in some ways the lower bound you can be exposed to as an investor in a market. You can't do much about it. You can't kind of diversify your way out of market risk other than being in different markets. But at that point, you are still exposed to the overall market risk. Volatility within a market defines a benchmark against which different companies that perform in that market would be measured, at least on one parameter called beta. Beta is a measure of relative volatility of a stock's price to the market benchmark against which it is compared, and we'll come on to that a bit later. So I'll leave it for now. Enterprise risk. I spent 15 years of my career dealing with this to some extent. So it is about the risk that applies to a specific corporation within a market. It's sometimes also called specific risk, for that matter, by the way. It is specific to internal and external factors that influence the performance of a specific corporation. There's that word again, specific, as opposed to market. And there's so many things that can affect this. It's very, very complicated topic to get your head around. And as an outsider of a corporation, it's almost impossible to get ahead of this. What does that mean? So one of the things we'll talk about on this particular slide here, if you look down the bottom, there's this graph. What does it show? It shows three assets over time, going all the way back to 2000. The bottom one, which is kind of down here that you can't see much of, is the S&P 500. The next one up here, the sort of darker blue color, is Boeing, the Boeing Corporation stock. And then the lighter blue color is, messed that one up. The lighter blue color is Aerospace and Defense Index Fund, which comprises a bunch of different aerospace and defense companies. I'll get into this chart in a moment, but I'll put it there basically to show the difference between volatility and risk for a company versus a market segment versus the broad market overall. And I want to get into that in a minute. What drives enterprise risk? So many factors. I'll put a few here: financial depth, execution performance, company strategy, its degree of competitive advantage. That in itself is a huge topic, by the way. And if I use a company like Apple, for example, Apple has built itself tremendous competitive advantage in so many different ways. Warren Buffett describes competitive advantage, enduring competitive advantage, like a moat around a castle. And he talks about companies that he's interested in have moats. So they've built themselves entry barriers that prevent other companies from really ever having an equitable but legal competition against them. How has Apple done that? They've done it through their branding. They've got an amazingly powerful brand. They have fantastic products. The products are beautiful. They're nicely packaged. They perform almost flawlessly. They're pioneering innovation virtually constantly. And more importantly, I think from Apple's perspective, they built an ecosystem. So the whole documentary about this as well, by the way, if you're interested, is when Apple kind of caught onto the idea of the App Store, what they did, I don't know in detail what they did. What it was apparent that they did was they published the hardware and operating system interfaces for the iPhone so that third-party developers could build applications that would run on an iPhone. That transformed the iPhone from being a a phone with a few neat features like a camera and internet connectivity into a computational appliance, a mobile computational appliance that different users could customize and use in many different ways by purchasing third-party applications that, lo and behold, Apple happened to validate and therefore market on the App Store. And it was just a brilliant marketing and technical innovation to think that way and create this web of dependencies. So that now if you give up on your iPhone, you don't just give up on an iPhone, you give up on the iStore, you give up on all the applications that you connect with. Just brilliant strategy in terms of building a moat and competitive advantage. Other factors are management competency, ethics, and how a company behaves. I mean, again, if you want some test cases on that, one of the whole financial meltdown in 2008, which is shown on that curve at the bottom there, where it says 2008 financial crisis, was largely driven by greed in the financial markets in the US and misrepresentation of the level of risk that investors were exposed to. Even prior to that, when Enron melted down, I can't remember when that was, a long time ago, probably around about 2000-ish. Enron was misrepresenting the value of the assets on its balance sheet. Enron was an energy distribution company, and it was misrepresenting the value of its corporation. Managers were behaving unethically. Everybody believed the emperor had no clothes on until somebody pointed out that, everybody believed the emperor had clothes on and that the clothes were beautiful, until somebody pointed out that, well, no, he didn't actually have any clothes on, at which point the thing vanished in days. Enron went from start to complete collapse in very little time at all. And I read an entire book on that, which was fascinating, the extent to which management, honesty and integrity first elevated a company to being the darling of the stock market, but it was a house of cards that collapsed in no time at all once the unethical behavior was exposed. Talking about ownership of specific factors, intellectual property in the case Apple, resource availability, can you get the raw materials that you need for your business to function? What if you're a battery manufacturer and you're relying on cobalt from South Africa and there happens to be a revolution in that country and suddenly you can't get your cobalt? Then you got a problem. Or people, if you can't get the right human expertise to do the things you need to do in your business, and that can affect the business. Overreach is a classic thing where companies try to scale self or take on things that are beyond them, but they do it because of this drive for growth. And the ability to scale is not consistent with where companies try to position themselves. And I've personally been involved in a couple of examples of that. And fortunately, we've been able to manage our way through it, but it can take companies down. Anyway, a bunch of factors that influence the way a corporation performs relative to its market. You can never know them all. You can never know the reality of them all. You can only believe what is public when you're trading in public stocks. Therefore, there's risk there. I guess the good thing about enterprise risk relative to market risk is it can be reduced by diversification within a market segment. So instead of just owning one company, you can own a bunch of them. And we'll come back to diversification. I want to go back to this little graph here for a minute because there's some interesting stuff on here. So you can see both enterprise and market risk at play on this graph. 3 lines. Well, the first thing we notice about the purple line is you can't see much of it because it's bouncing along. Very shallow gradient for most of the time. The numbers in these little boxes here represent the overall growth since we started. What do you notice? Well, the S&P 500 has grown the least. It's a diversified portfolio of 500 companies that represents the overall market. That sort of shows how big the market has grown. If we look at Boeing, the dark line, where's my little pointer thing gone? Oops. I lost my little pointer. There it is. So here's Boeing. What we notice is, well, first of all, it's more wiggly than the purple line. That's its volatility. And then we see this thing happen here. This was when the first 737 MAX crashed. Well, guess what? It also affected this other line. This is the aerospace, US Aerospace and Defense Index. Well, why would that happen? Well, because Boeing is a large part of the US aerospace and defense sector and is therefore representative of a good chunk of the value of this index fund. So even the single company it's failing has affected that index, the aerospace and defense index. They both collapse there. Then what do we see? Well, we see a sudden spike in recovery for Boeing there, which my assessment of what happened there was investors fled Boeing when the 737 MAX crashed in anticipation of the thing collapsing. And then all the stories come out about, well, it might have been pilot error, it might have been this, or it might have been that. So investors think, oh, geez, I've prematurely abandoned Boeing, I better get back into the stock, and they drive the price back up. The index responds similarly, except it takes a bit longer to recover. But what we notice here is the two cross. We see Boeing continue to decline. We see the index recover. So there was a second 737 MAX crash for similar reasons. Then it becomes understood that there are some systemic problems with that aircraft in the flight control system. There's a whole story on that, which again is itself worth watching. However, what came out of that wasn't necessarily the technical details associated with the 737. What came out was that there were cultural changes within Boeing that, if you like, drove employee behavior more towards shorter term financial performance than longer term engineering integrity and honesty. That put a cloud of doubt over the corporation. I think the CEO ended up getting booted out. They hired a new guy, and Boeing's still on a course to try to fix itself. So you see it happening, yeah. By the way, commercial aerospace is only one part of Boeing. It's a large part of the company, but it's not everything. There is a big defense play in Boeing, which tends to stabilize its own stock against certain shocks within parts of its business. I think, however, if you've got a management integrity problem, then that can affect everything within a business. So for me, there was still a cloud over Boeing until they figure out, what's going on inside the company. So anyway, the aerospace index growing for a bit, and we see Boeing in a bit of a decline there. We see the S&P 500 just gradually chugging along there in the background. And then this happens. Well, guess what happened? That was COVID. So there's an example of market risk again. So we've got overall market performance here. We got individual companies and indexes that have greater volatility than the market itself. We have the 737 MAX and Boeing's struggle to get over that. And then lo and behold comes along a market shock in the form of COVID. Nobody's flying anywhere. Nobody can go anywhere. There's all this fear and anxiety and panic in the economy. Aerospace and defense and Boeing and everything takes a hit. There's the overall hit. Look at the difference in size of the hit. If you own the aerospace or defense hit, it's massive. It's S&P 500, it's a huge percentage. It's less relative. But then what happens after that? Then we start to recover again. But look at the difference in the swings on Boeing and the swings on the aerospace and defense index compared to the overall market. Much higher volatility, higher risk. But look, again, if we go all the way back to 2000 there, and we say, well, we'll aggregate net of all that, well, you'd have been better off putting your $10,000 in the aerospace and defense index than you would have been putting it in the S&P 500 or Boeing. It would be interesting to see how this continues ad infinitum. We're going to kind of come back to this notion of diversification as a strategy with the ups and downs of it. But with the benefit of hindsight, if you could have gone back and said, I wish I'd put my $10,000 somewhere, you'd have put it in the aerospace and defense index out of the three. That's not a recommendation, by the way. It's a snapshot in time, and it's a rear view mirror view, which is always easier to figure out. I'm not going to dwell on this one, but you need to know about it. Counterparty or default risk. This is where a party involved in a transaction fails to fulfill their obligation as part of that transaction. So, for example, if you go to the bank, you go to the bank machine to get money out. If the bank hadn't any money, they can't give you any money, you've been exposed to that risk. Your house is wrecked in a tornado and you fill out the insurance claim, but there's 150,000 other houses being exposed to the same tornado. Insurance company goes bankrupt, called an insurance policy, but the entity that signed up that contract is gone. On the other hand, you might default on your mortgage or credit card payments, and then the bank is left exposed. They've got to go chasing around you to sue you or negotiate some deal where you pay back over a longer period of time, some affordable amount, so they can get their money back. The bank is then subject to counterparty risk. A bond issuer, we talked about bonds in one of the earlier versions of this, a bond issuer might default on the repayment of the principal on a bond. So you buy a bond with the assumption that in 5 years' time or 10 years' time, you're going to get your money back and you've earned all the interest in the meantime. But 7 years in, the company goes bankrupt and you're left with a bond that you got to go then sue the residuals of that company for to try and get some of your money back. In order to accept this risk, investors or institutions require a premium to compensate them for taking that risk. To me, the best example of that is, there's two really good examples. I mean, one is credit cards. Credit card defaults are high. Not surprisingly, a lot of people don't pay their bills. Banks don't like that, so they charge higher interest to offset the risk of that. So out of, I don't know what the default rate is, but let's say it's 5%. 5% of people don't pay their credit card bills. So the bank essentially spreads the cost of that 5% among the 95% of people who do pay their bills by charging them higher interest rates. If you're behaving properly with your credit cards, you pay them off every month, that doesn't affect you. It only affects the folks who carry a balance and get subject to that high interest rate. That's how it works. If a party is expected to take higher risk, it's expecting a higher return. As an investor, you are exposed to some default risk and you have few means to deal with that other than by dealing with reputable organizations. I got a typo in my slide there. Sorry about that. Quality control issue on my part. So as an investor, let's imagine you got, I don't know, pick a number, $5 million, and you put all that in the Bank of Montreal, and then the Bank of Montreal goes bankrupt. What do? Well, there's a thing called the Canadian Investment Protection Fund, which essentially provides insurance for assets that are held by approved financial institutions. It has a limit on that of $1 million per individual, per institution, and per class of investment as well. So if you had RSPs and you had non-registered investments, you get $1 million worth of protection in each one. But you don't get $5 million worth of protection. So if you're a high net worth individual, you got all your money in one bank, the bank goes bankrupt, the best you're going to get back is $1 million. That's an example of counterparty risk that would apply to a certain class of investors. Overall, this is generally less of a concern to investors. However, it is real and you need to pay attention to it in your life. I make reference here to my uncle Dave, now deceased. He worked for the same company for decades as a draftsman. When he was approaching retirement, he was in his 60s. The company went bust, essentially. So they reneged on severance. So they didn't get any severance. And the company had also spent most of the employee pension fund in trying to keep themselves afloat while they were trying to save the business. So not only did he not get any severance, he didn't get his pension either that he'd contributed to for decades working for this company. After a long sort of legal process, there was some kind of class action lawsuit was raised against the company. The former employees got some percentage of their pension back, a small percentage. I think it was like 20% or something like that. So this guy worked for a company for years. He was entitled to severance when the company closed. He didn't get that. He contributed to a pension for years. He ended up with about 20% of it. That's an example of counterparty risk affecting your average Joe Blow in a very, very material way, i.e. this shit happens. You got to pay attention to that as you go through life. Relative risk. Okay, so we talked about market risk and we talked about enterprise risk. Beta is a term that you'll see when you look at a stock chart, or you're looking at an investment website. You'll see a term called beta. What beta describes is the extent to which individual stocks' price varies relative to the underlying market or segment that they are in. Usually it's the overall market. So, let's say the market wiggles up and down. It has a wiggliness of, of 1. Let's just imagine we term wiggliness as 1. It's actually a very complicated statistical calculation involving things called covariance and variance. Covariance being mutual variability, variance being variability measured against some other benchmark. You don't need to understand the statistics. You just need to understand what beta subjectively represents. It subjectively represents the degree to which a stock's price will vary relative to swings in the market. So as the market goes up and down, wiggling, the stock will either go up and down the same amount or less or way more. Stocks that have a beta equal to 1 will essentially wobble around the same as the underlying market. Stocks with a beta of higher than 1 will wobble up and down a bit more. We looked at Boeing previously. Here are some examples of other companies. Boeing is obviously higher than the market. Apple is a bit higher than the overall market. GD is apparently lower than the market. That surprised me. I didn't expect that. And Berkshire Hathaway is lower than the market as well. I kind of didn't expect that either, but I expected both GD and Berkshire Hathaway to be round about 1, but so that kind of surprised me a little bit. Beta can be useful when you're looking at the relative risk of a stock compared to the market, but it can also be very deceiving. It's a very complex parameter. It's statistically derived from a whole bunch of data, and it can be useful, but it can be misleading. And I kind of closed that off with the stock can have a low beta, i.e. it can be, it can track the market. But it could also be on a downward trend or an upward trend. So it can be varying a little bit, but trending up, or it can be varying a little bit or trending down, or it can be varying a lot or trending either one of these directions. So it's useful, but needs to be carefully interpreted. Diversification. One method, I'm just going to plug my computer in before the thing dies on me here. Diversification. So if you think about the risk presented by different enterprises in a market, if we only own one stock, we are subject to our total investments are subject to the various factors that we talked about earlier that affect enterprise risk. So if the only stock you had owned in the world was Enron, when Enron went bust, then you were doomed. You lost everything. If you diversified across a market, you reduce your exposure to single corporate failures. You also reduce your exposure to single corporate explosions in performance. If you own 100 stocks and you got 1% of your assets in each of 100 companies, and one of the companies does really awesome and as the stock price takes off, you get some of the benefit of that, but your total exposure doesn't get you the whole benefit of it. I think you can, to some extent, get some diversification away from market risk. You can invest in stocks in different countries, so you can avoid potentially one country has a revolution and the whole market dies. If you're diversified, you can avoid some of that. But you can't really get rid of the global variables that tend to impact overall markets. If you're an expert, and I put in brackets there, really a prophet, and I think I mean that, you can skillfully predict how the markets and individual companies will perform in the long run. Most people can't do that. For most investors, including professional investors, it's not the case. Most active fund managers who would work for TD or the Bank of Montreal and would manage large chunks of money in mutual funds, they don't outperform the market. by the time you take the fees off that these guys charge for all the analysis to do and all the clever thinking they do to try to pick stocks that are going to outperform, usually they don't. Some people claim they do. You kind of got to look behind the scenes to figure out if that's really true or not. Caution here, owning different stocks or funds does not guarantee that you are well diversified. For example, if you own both Bank of Montreal and Toronto Dominion Bank stocks, well, guess what? They are both exposed to the same underlying market risk. And because they both operate in the Canadian market, they may be both exposed to the same enterprise risk. Obviously, they've got different management teams and potentially different cultures, but they're trying to do the same things in similar markets. So that you could expect that, reputable companies that are large could have similar enterprise risk levels in some cases. So diversification, you got to look under the hood to figure out if you're really diversified. I've put some examples here to sort of show you how that means practically. These are diversified ETFs. I own little pieces of each of these. One is an oil and gas one. There's 10 companies in that fund. So I own stocks of 10 companies by owning one unit of that ETF. ZSP is the US S&P 500 index. There are 500 companies in there. So if you buy one unit of that ZSP ETF, you actually own a little piece of 500 companies in the US. And CDZ is another Canadian ETF. It's exposed to a segment of the Canadian market. There are 90 companies in that fund. So you own one unit of that, you own a little piece of 90 different companies. That's diversification. What are the key takeaways from this lesson? Well, risk is a necessary component of investing. Whoops, what happened there? I guess I got rid of my slide. You can have market risk and you can have enterprise risk. Market risk overall can't really be mitigated by diversification other than what I mentioned about, geographic exposure, if you like. Enterprise risk can be mitigated by proper diversification. The overall effects of risk on a portfolio cannot be objectively predicted. It is about probability. And there's no free money. No risk equals no return. Lastly, and I didn't talk about this per se, but I want to link it back to some of the earlier lessons. The longer you are in the market, the more you reduce your long-term risk. The market goes up and down, but generally it goes up. So depending on when you join the market and when you get out, you can reduce your risk. The earlier you join and the longer you stay in, the more you reduce your average risk by riding through those periods of performance. And you benefit from the tremendous power of compounding, which we talked about earlier. Therefore, you got to start young. Here ends the third lesson. Thanks for paying attention all the way through that, and hope this was useful.